Guten Morgen, Wien. Thanks for inviting me to speak virtually at the Building Bridges for Financing a Sustainable Transition conference. Building bridges between science and policy, between banks and supervisors, between multiple disciplines is exactly what we need in light of the ongoing climate and nature crises. Bridges are built at conferences like these, facilitating an exchange of views between the latest scientific insights and ever-growing good practices. Bridges connect local actions with global impacts and help formulate short-term goals grounded in a long-term vision. Let me start with a simple but important point. Central banks and supervisors are not climate and nature policy makers. Central banks and supervisors are climate and nature policy takers. While we pursue our mandate, we look through the window and clearly see the climate and nature crises unfolding and affecting our economy in profound ways. Think of the devastating wildfires in Los Angeles, literally burning away people's homes in a matter of days and leading to damages worth hundreds of billions of dollars. Think about the floods in Slovenia in 2023 that washed away 16% of GDP in a matter of hours. And think about the horrific events last fall in the Spanish region of Valencia, leading to damages of around 17 billion euro. So if we were to simply close the window shutters and ignore the economic implications and financial risks from the climate and nature crises, we would risk failing to deliver on our mandate. Instead, to make sure we remain effective in our task of maintaining price stability and keeping banks safe, at the ECB, we keep looking outside that window. We currently see geopolitical and economic fragmentation, but also global heating and nature degradation unfolding. Hence, we must consider the impact of all these factors on inflation and on banks' safety and soundness. So where do we stand? In our 2021 Monetary Policy Strategy Review, we concluded that since climate change profoundly impacts economic activity, accounting for global heating and the transition in our decisions is paramount for our task of maintaining price stability. And in the 3 years since then, the ECB has made significant progress in improving our ability to take climate considerations into account in the macroeconomic analyses that inform our policy decisions. We have found, for example, that increases in food prices following extreme heat waves were an upside risk to price stability. For instance, an interdisciplinary study by the ECB economists and climate scientists showed that the 2022 heat wave in Europe added 0.8 percentage points to euro area food price inflation. Since then, new heat records have been broken, meaning that the impact is expected only to increase. Moving from price stability to banking supervision, our job description is crystal clear, making sure that banks appropriately manage all their risks. And the financial risks stemming from the ongoing climate and nature crises are no exception to that principle. And this is why since 2019 we have taken decisive steps in making sure banks become resilient to climate and nature-related risks. And over the past years, most banks under our supervision have made good progress in integrating climate and nature-related risks into their strategies, their governance, and crucially, risk management. And that is clearly good news. But let me stress a crucially important enabling factor: data. To know where risks sit and where opportunities lie, the availability of reliable and comparable data is indispensable. And in this context, I'd like to stress that reporting requirements in the EU Sustainable Finance Framework are not something nice to have, but a solution to a problem, to improve the availability of reliable and comparable data. And when discussing current simplification initiatives at the EU level, it is therefore crucial that any attempts to simplify sustainability reporting for companies do not result in critically important data points being missing. If this were to happen, banks would either no longer be able to conduct adequate risk management, or they would have to resort to requiring additional data from their clients on top of the current regulatory regime, which would clearly be burdensome both for banks and for their clients. Moreover, the absence of standardized guidance on reporting requirements can also undermine a level playing field, as banks might set their own differing reporting criteria. Does that mean that there is no room for simplification? Does it mean that there is no room for efficiency gains? Of course not. But let us discuss simplification with a sense of proportion, and let us stay on course. Because good data is important to identify economic impact and financial risks. And it is also important for unlocking flow of finance for the green transition and thereby contributing to Europe's competitiveness agenda. So let me conclude. We know that a financial system that fails the planet ultimately fails the people. Regrettably, the world is currently on track for an average increase of 3.1 degrees Celsius. Considering this baseline, it is inevitable that climate and nature-related risks will increase. Concealing them will not make them disappear. And ignoring them will not make them less threatening for monetary policy and for banking supervision. We know that the economic benefits of a timely transition far outweigh the costs. And hence, if we fail to take action today, the costs will only increase tomorrow. The impact of climate change and nature degradation is systemic and hits our lives and economies through many different channels. And hence, one actor alone cannot achieve the transition. We all need to play our part. This is why building bridges across actors and disciplines is more important than ever. In this spirit, I wish you a fruitful and insightful conference. Thank you for your attention.